Good morning and welcome to the latest edition of Trending Treasury, Arlingclose's series of webcasts about treasury management, capital finance and everything in between. Today we'll be discussing Arlingclose's interest rate views and economic outlook, which we communicate to clients at strategy meetings, written briefings and our regular interest rate forecasts. My name is Nicholas Keeling, and today I'm joined by my colleague Phiroza Katrak, a fellow member of our interest rate group team, the group that actually sits down, debates, and essentially decides our outlook for dissemination to our clients. Morning, Phiroza. How are you this morning?
I'm well, Nick, and I trust you are too.
I am.
Yes, still working from home, like many people around the country as yet. Yeah.
Indeed, and I must admit, in 4 days' time, I think the 17th of May, as soon as I can go and eat and drink in a pub, life will certainly be looking up, and it will feel like we've moved on. I think.
Certainly, it's been a fairly long road, but long may the good news last.
Indeed, and that's partly what we're going to be talking about today. Indeed, in many ways.
Yeah.
We are discussing our interest rate forecast and kind of the thinking that goes into that. We do have a few slides. Before we start, I'll just say that if you do have any questions, use the question box to enter those, and we'll try and answer those as we go, as they pop up. So don't be afraid of asking a question of how do we come to our views, or indeed what we think the outlook's going to be in a slightly different way. So if you've got a different point of view, it'd be worth hearing that as well, and we can perhaps discuss that. I think it's difficult to explain or to give an interest rate view without recapping where we are. So I think the recap will include, how we've arrived at this point, but also include elements that explain where we're going to as well. So, Phiroza, I wonder if you wouldn't mind giving a very brief recap, maybe of 2020.
Indeed, it was a very unusual and indeed a very, very challenging year. And we had the huge economic dislocation from the first lockdown and then from the second and third waves as the pandemic spread globally and had ramifications for economies around the world. This was met by a huge amount of fiscal stimulus from the authorities, including the furlough scheme in the UK, which actually extends all the way through to September of this year. The central banks also played their role with a tremendous amount of policy stimulus, with rate cuts as well as QE, and the asset purchases that underlie QE, that those two are rolling forward into 2021. And in the second half of 2020, we also had the impending US elections. Now that's been settled. You have Joe Biden in the White House, and the Democrats hold the House of Representatives only by a very slender margin. And it's a 50-50 split in the Senate, with the vice president able to cast a vote in the event of a tie. So in effect, a very slender majority in the Senate. And then, of course, we had the impending 31st December date for the exit from the UK's exit from the EU. Would we leave with a deal or without a deal? Now, as we know, we've left with a deal, but the lingering Brexit effects will only be felt in later on this year and in the future. Then in November, we had the announcement from Pfizer-BioNTech, the very first of very successful vaccine against COVID, and that raised spirits and raised hopes that things would be better. So that's where we were come the end of 2020. So it's now worth concentrating on what's happened in the markets and market reaction since the beginning of 2021. And Nick, maybe you'd like to pick up there.
I'll pick that up. I think it's just worth pointing out you discussed as part of that, Phiroza, the amount of stimulus, central bank and government stimulus, really, dare I use it, unprecedented in its size, and it puts the response to the global financial crisis that response to shame, really.
Indeed.
So I wonder if there was some thinking when they look back on the global financial crisis and think, well, we could have probably done a lot more and dug us out of the hole quicker. And they've definitely from my point of view, the government's the UK government. Not everyone's going to be happy with exactly what they've done, of course, and with the Bank of England, but they've definitely stepped up to the plate. And if you like, well, they've managed, the economy's managed to, despite the falls that we see on that chart in front of us, it would have been so much worse without those responses. So we need to bear that in mind as we move forward. So what have we got at the moment? So if actually there's a chart, the next chart actually in this sequence just looks at the year to date in terms of 10-year government bond yields for both the US and for the UK. And what we've got here, we've got this period throughout 2020 that Phiroza was referring to, and it was a very stable one for bond yields. We'd had a very sharp fall in bond yields. Unsurprisingly, the outlook for the world, the UK and the world economy was pretty dire at points along in that period. And then you had, like we said, Brexit was proceeding and looked a bit fraught at times. There was talk about a no-deal Brexit really until the middle of December, so not long until the end of the actual leaving date. The US elections produced some volatility, of course, and the outlook there, the result there was quite uncertain for quite some time. But we moved into January and we moved into the new year. And immediately there was the vaccine progress had just started, but as we moved through New Year, new vaccines were coming online and actually starting to be distributed. In the UK, distributed extremely quickly. And again, however you want to, however you think the government's done it in this crisis, one thing they have done right is the rapidity of the vaccine rollout. Incredibly fast rollout, and that's been one of the drivers of this rise in gilt yields we've seen. You can see that on the chart in front of you, particularly that February period. We also had the Democrats actually, we weren't sure whether they'd have control or tentative control of the Senate really until the new year, despite the elections happening in November. It wasn't really until January until we knew the results. So you had that coming through as well. You had the vaccine rollout, and things started to look up. And after Brexit, the world hadn't ended. Yes, we had some real problems in January, but the world tended to go on. It was overlooked to some extent because of what was going on in the vaccine. And you can see that the result it had in markets. Markets had this view that actually things weren't as bad. And weren't as bad as we thought, perhaps, at the end of last year, despite the fact we were all in the UK, we were in this very severe lockdown because of the new variant. But it seemed like the vaccine was going to come through and sort those issues out. So you had this kind of thing, well, it's called reflation, this reflation trade at the start of the year. Really, that inflation isn't going to be around zero forever. Actually, as we come out of this, as we probably will do in the next year, it will bring a surge in inflation with it. And we can't say that's wrong, but we can cast some doubt perhaps on the sustainability of that, or at least look at the sustainability of that. Is it going to be a short-term issue or a long-term issue? And that's really what drives our forecast going forward. So that's where we are. You can see since March, actually, gilt yields in particular have been very stable, and perhaps we'll look at the makeup of nominal yields towards the end of the presentation. But you see, despite the continued rise in the vaccine rollout, yields have been very stable. So it's almost like the markets have taken that view. They've said, well, things are going to be better, but we don't see it getting that much better, or we've priced in a lot of the good news already. Of course, what we've had over the last few days is a continued rise, Phiroza. You've seen this as well as I have.
Indeed.
In gilt yields. And today, well, yesterday, really, especially from the US CPI print, which came in well above expectations. So we can talk about that as we move through. So I think, so there's the recap. That's where we are, and some of those some of those factors, the US presidential election win and control of the Senate and government essentially for Democrats, the vaccine rollout, the move to recovery, and I know things are bad around other parts of the world, so that's not assured in itself in terms of the pandemic, but there's a feeling that we are moving towards a non-pandemic world, particularly in the UK perhaps. Those feelings driving gilt yields and are going to drive the outlook further. So I think before we actually look at our current forecasts, it's probably worth looking at, what really informs, or what are our underlying thoughts about interest rates, possibly. Phiroza, and I mean, I'll start off. We generally at Arlingclose we ascribe to kind of this lower for longer outlook, and I think none of our clients will not be aware of that lower for longer outlook. I don't think it's been with us really since the great financial crisis, and yes, there have been moves around that point. We haven't said that interest rates are going to stay all-time lows forever, but it's a feeling that actually as we move forward, as technological changes take over, demographics obviously pushes to an aging population, that you need lower interest rates. The environment will be less inflationary over time. So actually interest rates will remain low and can remain low, and low interest rates aren't an aberration, they are a response to the environment. And I think that weighs, that informs our views in general, and then obviously we build on top of that for current events. I mean, in terms of the pandemic, Phiroza, has that changed our view there, that particular viewpoint that we have? Is that been challenged by the pandemic?
Well, I think if anything, it's probably been reinforced by the pandemic, simply because we take a look at consumer caution right when we come out of the pandemic. As you say, from the 17th of this month, there will be probably that surge in relief spending, that's that relief rally coming through. But are we going to have a continued and absolute return to pre-COVID spending? I think time will tell. There will be a certain degree of caution, particularly for those whose jobs are on furlough. What happens when you come to the end of September and furlough unwinds? Also, I think it's been quite a salutary lesson to say that you need to have some kind of savings if you can. Those who've been able to work from home, and just because of the lack of economic activity and the lack of just being able to go out and spend, maybe they have savings. But for many, it's been a very, very harsh time. So will we have a behavioral change as a result of the pandemic? That's something that will be seen perhaps in the next quarters or even over the next few years. So we'll see how this pans out, and it's not a given that we will go absolutely back to where we were in 2018 and 2019 without any qualms about saying let's put aside something for that just in case, because the way COVID hit us, nobody was prepared for it, not least governments and indeed households. So I think that behavioural change is something that we need to be seen, and how that progresses. And ultimately, we talked about things like commodity price rises when we see that coming through. Is that a given? Will they always be high? Can those be passed through? So let's look at some of those sort of current conditions and the current thinking that we have over here. So initially, household spending will likely to drive the recovery, but exactly as you said, will it be sustained? It's the sustainability of inflation as well that we need to see.
I think that's right. And I think again, so you've got that kind of longer run feeling that we have that underlying.
Yeah.
We don't know what's going to happen and whether that's going to change out of the pandemic, or whether the pandemic simply accelerated that long run change and supported it. And you've also got now a huge overhang of government debt. So then you've got to look how, if interest rates rise markedly, how are governments going to fund themselves without removing even more and more money from current budgets? So that's a key element as well, and it's certainly something that we're that we're well aware of, and it almost puts a cap on on where interest rates can go to. So I think it's worth at this stage looking at the next slide, actually, which is um, our forecast for official bank rate. One of the questions actually is, what do you think will be the long-term trend for bank rate? Well, we tend to look at in 3 years ahead, so it's not really long-term; it's more medium-term. But hopefully, you can get a feeling that we're not expecting bank rate to shoot off into the distance. That's certainly not Arlingclose's view. Although, of course, we will change our view as conditions change. But just to explain what we're seeing on the page, and again, client viewers will be well aware of this picture and how it works. Our central case here for bank rate is flat. You can see that from the red line. So 0.1 from the end of June all the way to June 24. On there, around that point, though, I mean, we're not so arrogant to say we're 100% right 100% of the time. There will be times when bank rate will move away to either side depending on current circumstances. We think the long run will be at 0.1, but we do leave some room there for upside. You can see that with the range, which is the pink area. So we still build in a chance of a fall moving into 2022, and we build in chances of a rise relatively soon, relatively small rise back to 25, and then perhaps another one in as we move into late 22, just to capture some of the uncertainty. And we'll hear about this more as we go through. Uncertainty is key at this rate. Phiroza and I can sit here and tell you how everything's going to be, but the range of outcomes from this point is particularly wide. And you can see that in some of our forecasts, and you'll see that in the Bank of England's monetary policy report as well, which we might talk about later. But anyway, so what else is this chart showing? It's showing the market forward curve for SONIA. So we use the market forward curve for SONIA, which is the overnight rate, of course, as a proxy for bank rate. So we use it as a market projected a proxy for bank rate. And you can see the market here as a slightly different view to us, actually. Say slightly, just be aware of the axis here. It runs from -5 to 1.5. It's not a wide axis, so clearly that's going to any change we have in these lines is going to look much sharper than it actually is in reality. But the market has built in forecasts for rise in SONIA, a rise in bank rate from the middle of 2022 onwards. Okay, out to 2024, rising to just over 0.5%. So we are divergent in the views there. We don't feel that the Bank of England really needs to raise bank rate from where it is. There's a few reasons for that. And I think this comes back to our discussion we've already had, Phiroza, really, which is what's sustainable. So we're going to see a rise in inflation, aren't we? I mean, that's a given. Inflation was very, very weak last year. Inflation certainly has picked up. I mean, it's not that we've gone to normal levels. It's definitely, you mentioned commodity prices, Phiroza, and we'll look at perhaps input prices later. But commodity prices, copper prices, lumber prices, they've all increased quite sharply. And there's a variety of reasons for that. It's not just demand led. There's a supply issue there as well. But what we see here is we think actually some of these effects will be temporary. So yes, inflation will rise quite sharply initially over the next few months. We'll see it. We saw it with the US CPI print yesterday, which took the market by surprise. But will it be sustained? And the main question there is, will economic growth, which will also be strong over the next few months, and quarters, it come through really strong prints, will that be sustained? And I think that's the main question here. Phiroza, you're muted.
That is being echoed even by the Bank of England. If you take a look at the latest MPC minutes, it says the MPC will focus on the medium-term prospects of inflation, including the balance between demand and supply, rather than factors that are likely to be transient. And obviously, when you compare CPI taking last year's very low base effects, it is going to look quite sharp initially, but it's the sustainability of those numbers.
That's right. And so to make, what do you need for inflation to be sustainable? you need sustainable growth, which feeds into wages and income. So that's the key. What we are going to have a rise in inflation. It is driven to some extent by changes in supply. We are seeing that being changes in raw material costs. We can talk about how much that will be fed through, of course, to consumers. We've talked about consumer caution already. But how much will that be fed through? Will it be able to be fed through? And will it be able to be sustained? Will wage growth pick up and allow prices to be passed on to consumers over a sustained period of time? If we think back to pre-financial crisis, which is a long time ago now, it doesn't feel long for me and possibly for other people listening, but it is a long time. We had wage growth of 4% consistently. It was very consistent, 2% above the CPI rate. And so it was sustainable. So prices could rise because consumers, households were earning more money and then could pay for higher prices and so on and so forth. What we've had since the financial crisis is really struggling wage growth. So labour costs, we've seen an increase in employment maybe instead of an increase in wage costs, which I think is definitely one of the reasons why inflation has struggled really over the past 10 years or so, to really push higher and maintain a sustainable level. I think if we go back one slide actually, or two slides, sorry, we can actually see there that the CPI, this was January's CPI, was actually below target in January 2020. It wasn't. We haven't come from a high inflation environment and collapsed from there. We were actually struggling to make target prior to the pandemic. If you just go forward back to the forecast. So talked around it a bit there perhaps, but we do expect the rise in inflation. We do expect growth to be temporary, and that's one of the reasons why we expect bank rates to remain. And it feeds into, Phiroza, what you said about the Bank of England, the MPC. The MPC is highly uncertain.
Indeed. And you can see that from the dispersion of the colours, even in its monetary policy report for inflation. It goes from -1 to 5. That's a huge degree of uncertainty.
Indeed. And then what they've also said, and this has been echoed by other central banks, they're waiting, aren't they? They're waiting to see some discernible change in inflation that is sustained. So that really means that the uncertainty is so great for policymakers. What they don't want to do is raise rates ahead of any perceived change. That doesn't come through, and all they've done is slow down the recovery. And I think we also need to recognise that the economy is taking a massive shock. It's going to take a while. Once we get past these few quarters, it's going to take a while to get back to some kind of normality. Life is going to be different than it was pre-pandemic, and there's going to be an adjustment period, Phiroza, I think it's fair to say, isn't it, after that point? That's
right. We call that the adjustment period, and right now nobody has perfect vision as to what that adjustment period is going to be. That behavioural change, you'll have to wait and watch and see what exactly it means for the medium to longer term. And in fact, it comes to one of our questions: what do you think will be the long run trend for bank rate? And you've alluded to the fact that it's still going to be pretty much lower, simply also because of the overhang of central government debt.
Yeah, indeed. So let's move on. I mean, in terms of the other aspect we've got to think about as forecasters is, and I think we touched on this, is will households spend their savings? That's a key one for Andy Haldane, of course, who's soon to be an ex-member of the MPC, but very much is a lead member at the moment. And it's something the Bank of England have got to struggle with. It's something all forecasters have got to struggle with. How much of those savings that how some households have managed to put aside is going to be spent over the next few quarters or longer? That's the key as well. That feeds into the sustainability question, doesn't it? I think we've agreed, Phiroza, on here. We think consumers will remain cautious.
Yes, absolutely. Yeah.
We simply don't know what's going to happen in the future. The other question here is around business investment. So a business is going to pick up and start investing. Well, we got an interesting picture from the Q1 GDP, which was in line with expectations yesterday or day before, I think, when it was published. But actually, the split showed businesses were even more cautious. Now, you might say, fair enough, we've just gone into a lockdown, we don't know when it's going to end, but they were more cautious than expected. Households were more cautious than expected, and it just feeds into that view of we don't know. The uncertainty is huge, but there probably will be caution coming out of this beyond the first few months. So that's what a long explanation perhaps of why we think bank rate will remain at 0.1 rather than rising. And we can move on to gilt yields. I don't know if you want to say a few things about gilt yields here, Phiroza.
Well, we've seen that sharp rise in gilt yields in the first part of 2021, but then, as you've mentioned, they've more or less plateaued and moved sideways. Yes, there is a jerkiness if you just look week on week, but more or less the trend has been fairly flattened. We haven't seen that huge jump as we saw in late January through to sort of early February. It's again, inflation expectations probably rising in there, and there is, as you've often told us and the rest of our team, is that the interplay between real and nominal yields, because inflation expectations picking up, but not necessarily the reason for the rise. It's not absolutely the only reason for the rise in yields. And ultimately, would inflation be detrimental to long-term growth? And that's what we need to consider as well.
Yeah, I think that's a really good point, actually. Rather than looking at the yield forecast there, probably if we go on to the next slide. So this is showing, I'm a bit conscious of time as well, so we'll run through this, but this is showing inflation rates, and you can see UK CPI rate there, the red line obviously on a downward track through the pandemic. But input and output prices, so producer prices, so how much is the price the producer paying for raw materials increased or changed from the prior year, and the same as how much are they selling those on down the supply chain, and that's the output price. The input price, obviously the raw material price here. So what we've got here is that input prices are very, very volatile, as you can see. And so when the price of oil hits an all-time low, as it did during the pandemic, or when copper prices come down, clearly businesses are not going to be paying as much as for commodities. You can see that a very sharp fall in input price inflation, but that's resumed very quickly. It's bounced back very quickly, and now we've got almost a mirror image to the upside. Input prices are now up 6% year on year. Output prices are now up 2%. So you're seeing that those rises in commodity prices feed through into producer costs and into producer prices, and various surveys will suggest that prices are really hotting up. Look at the manufacturers PMI and things like that. The breakdown of that says pricing power is really picking up. Will it be fed on? Well, you can see from the CPI rate, it tends to be a lot less volatile, of course. And so there is that about consumer caution. We'll talk about that, but some of it will have to be passed on. It will have to be passed on. The question.
Go on.
The question is whether it's the right inflation, and that's what we've touched on here. And I've probably been beating around the bush about, is it the right inflation? And we talked about this about, is it going to be sustained? Well, if commodity prices go up very sharply and prices go up very sharply, but there is no wage growth, and there is a question here I can see about wage increases post-Brexit and a tightening labour market. So this is all interlinked. Will there be an increase in average wage growth that allows this rise, this supply, this cost push rise in inflation? Because that's what we're seeing here. It's all coming through from commodity prices. It's cost plus push, which is driving prices upwards. And you saw that with the US CPI print. A lot of that change was actually secondhand cars prices, actually a third of it, which was actually based on the fact that first-hand cars, new cars, they're not being produced as fast as they need to be because we've got supply chain issues with chips. I think it's semiconductor chips, isn't it, Phiroza?
Indeed, there's a worldwide shortage of semiconductor chips, and that is particularly affecting the shall we say, the automobile industry around the world, not just in the US.
So these issues are going to be driven through. They're going to affect consumer prices. But if wage growth doesn't pick up, we as households will be buying less goods for the same amount of money because the price will have gone up. So it depends whether we can sustain that. And this feeds into that uncertainty that Bank of England are seeing, and we don't believe that it will be sustained. And you can see maybe on the next slide, Phiroza, you talked about what the market is looking at. So the market's interesting because you get a rise in gilt yields because of big CPI data, perhaps, and it looks like everyone's building in inflation expectations, or they're building in interest rate expectations, but actually you've got to look how those are broken down. So here we've got, this chart is showing the nominal yield, so the 10-year bond yields in grey. So you can see that, and what it's showing is not the actual yield, it's showing the movement in the yield since the 1st of January. So when we saw the big change in yield, as you saw on the previous chart. So the 10-year government bond yield has increased about 65 basis points since the 1st of January. You see that's bounced around, it's been quite volatile, but relatively stable maybe since the start of March. Underlying that, though, we've got breaking it down to interest rate expectations, which is the break-even rate, the red line, and if you like, just rate expectations. So, sorry, inflation rate expectations is the red line and interest rate expectations is the blue line. And you can see that we've got initially they both rose together to some extent, but you can see that inflation's really taken off, inflation expectations, and it's actually contributed most of that change in the nominal yield. Whereas real rates, interest rate expectations, haven't changed really much at all. But what signal does that suggest? Well, it suggests that the market's looking at this and saying, actually, this is cost push inflation. It's the wrong inflation. It's going to drive prices up, but not actually. Growth will be impacted in the medium term because we're all going to be spending more money on fewer goods. So that's why we think that interest rate expectations, the real yield movement here hasn't really changed a lot. Now that might change. You can see how volatile these series are, and the relationship might change going forward. But it really suggests to us, it kind of underlines our feeling that what we're going to see is a temporary rise in growth and inflation, but actually the longer term path, it's going to be different to where we were, Phiroza, but I don't think it's going to be hugely different to where we were pre-pandemic.
Indeed. And that brings me to a very interesting question. There's a growing lot of investment balances competing for yield-bearing assets. Is this a result of QE? Because QE has driven yields low. And will it mean yields and rates will remain low forever?
That's a good question. I think, yeah, I mean, well, that's interesting. There's almost a substitution effect there, but you're right. QE, which is still ongoing. A lot of people have talked about, they're stopping monetary policy. The Bank of England are going to be buying more assets at a slower rate until November, unless they change their policy. But what does it mean when a central bank owns huge amounts of each market? And it isn't a forced seller or anything like that. Well, it means that everyone has got a lot more money, and you're right. Where's it going to go? So there is a yield hunt out there. We've seen really sharp shifts in equity markets recently, but that takes away from the fact that the US markets were regularly hitting new record highs at times, and it's definitely driven to some extent by QE and the fact and what QE represents, or the fact that monetary policy will remain low for a long time. I think that's partly it, isn't it, Phiroza? It's
indeed.
And one thing we haven't talked about, there's still plenty to talk about, but I think we're running out of time, is the effect of US fiscal stimulus and the impact that might have.
Indeed, and that too is ongoing. And they also have household savings. So yeah, will fiscal stimulus almost become the norm for economic stimulus?
Indeed, and that's got ramifications for our interest rate forecast, of course, as well, and yield forecast. That will certainly change things if indeed becomes the case. If we just move back two slides, sorry, just to finish up, I think, on this discussion. If we can move back to our 10-year gilt yield forecast, which is 2 slides ago, okay, or we can lose the slides. what it did show, again, to underline the uncertainty, thank you, underline the uncertainty, you can see that our line, really, our central case is basically a flat line. The market is pricing in movement. Actually, if you take our bank rate forecast and actually abstract the fact that the market at the moment thinks there'll be rises in bank rate, if that comes back down to our bank rate forecast, you'll actually see the grey line here falling back to our forecast, or very close to our forecast. So part of this is a difference in how we see short-term rates developing, and it's purely a mathematical impact. But you see it's basically a straight line. But again, to draw your attention to the wideness of that band, uncertainty is huge. Some of the risk to this US fiscal stimulus, we talked about how households use their savings over a sustained period. Will the pickup in confidence lead to the roaring 20s? I've heard a few people talk about that, and this boom period of like we had in the 1920s out of the Great Depression, which is ominous. But still, this period of constantly driving growth, sustainable growth, is going to lead us forward. All these factors really feed into this. Well, this is our central case, but there is a range of possibilities that can be driven by these various outcomes. So I think we'll leave it there, Phiroza. Thank you very much.
Indeed, thank you indeed. And I think, as you've just rightly said, uncertainty still remains part of the forecast theme, and that's not likely to change anytime soon.
Indeed. And so thank you. I should say thank you to those that left us questions. Make sure you tune into next week's Trending Treasury, of course. Hopefully another interesting subject. Then we'll let you know as that develops. But thank you for listening, and we'll see you next week.
Indeed. Enjoy the rest of your day. Thank you.